In this video, we will go into specific cases, and I'm sure you'll understand a lot more. We will start now. We have an example. Here is a 5-minute frame. Its structure is currently biased towards the upside. There is a significant resistance level for the buying side here. Due to the steep incline of this price wave, the body candles are also long, therefore a supporting factor for a buy opportunity at this level. Furthermore, when taking a broader view, we also observed that there was a strong uptrend prior to this. Then price consolidates, continuing bullish momentum, pushing higher. Now, let's see how the price behaves in this particular segment. Afterward, the price breaks through the buying side's resistance zone. At the next resistance zone, buying pressure pushed it higher. However, two opposing parties created this sideways phase afterward, a prolonged sideways phase with a tendency to decline more. At this point, the price is consolidating and breaking down. Now, we will take a broader look to understand why this phenomenon is occurring on a higher time frame. This is a 15-minute frame. This is the area we observed earlier, and it is currently located at a resistance zone for selling pressure. We can refer to this as the bearish territory within the bull-bear rule, and this bear zone is bigger than the bull zone at these two stages. According to the bull-bear principle, we observe that despite the bull camp dominating during this period, when approaching a larger bearish stronghold, the bear's ability to defend here will be greater. When bear join, they break the first bull's phase, leading to a struggle between both sides. The bearish side pushed the price down despite this bullish region. Having some supporting factors, this allows us to watch for a buying entry point. We can wait for a signal on the 5-minute time frame before going long. However, if we look from different perspectives, this area is actually in a large bearish zone, which is a factor not supportive of further price increase. Of course, at this stage, the price can still rise, breaking the major bearish zone, but it's about probability. Not every time the price reaches this area, it will be pushed down. Important, more supporting factors at the entry point increase the likelihood of price moving in the right direction. Conversely, the more unsupported factors there are, the higher the probability of a counter-trend move. In other words, it is necessary to observe how the buying and selling pressures are correlated, considering various aspects. We notice the buying zone isn't strong due to a significant bearish area nearby. In the same situation, it's favorable if this uptrend is within a larger bullish area, which is larger than this bearish region. Example, we had a bullish region here, and this buying zone is now supported as the price declined and rebounded from this significant bullish area. The main reason is the aggressive entry of the bullish camp in this major zone. Therefore, it's likely to break upward when the price reaches this area. This is a hypothetical scenario to understand the potential for further upside if the price remains high in this area. It's like having the same buy zone here, so that we have a buying zone like this at this moment. If previously the buying pressure was also strong, clearly this area is more supported. Conversely, this area experienced a strong selling pressure before the occurrence. Clearly, this buying zone is no longer safe, and the likelihood of a price breakdown is higher. Including an example, we have a strong bullish momentum, followed by a bearish momentum, and its buying zone is emerging at this stage. The price has just broken through a resistance level here. Per the bull-bear rule, the bearish camp is active in the market. As it reaches this level, a bullish force emerges from the strong uptrend earlier. The two sides are in a struggle, creating a sideways price range. Later, bullish momentum broke through the sideways range. On a smaller picture, it creates a beautiful buying zone. And if we enter a long position at this area, then if we target the profit taking to the previous bearish zone, at this peak area, that is entirely a reasonable entry point. It's precisely how we understand market structure, although they may appear similar at a certain stage. With similar entry points, the probability of occurrence will differ if that stage is placed in a different context. To make an entry point, there must be a specific context, a specific chart to consider how its future possibilities may unfold. Even if the price retraces in this time frame, without generating any entry signals and continues to move upwards, we can switch to a smaller time frame to assess the smaller bullish momentum. And if it creates an entry point here, we can still buy upwards. For example, like this. By understanding this, you can envision situations that may increase the likelihood of higher winning entry points. For example, this chart is in a larger time frame. Although the price is currently rising, we can envision a scenario where the price reaches this bearish region and a certain signal appears. At that point, we can prepare to enter a sell order. When it comes to entry signals, it can be either a pattern or a bearish structure. This depends on each individual's preference for which signal or price pattern they consider to be a reliable indication. And to determine that, you certainly should not use a real account to trade immediately. Instead, using a backtest account will help you evaluate the effectiveness of entry signals or a set of trading rules. Backtesting helps us become familiar with entry points, improves our reflexes, increases confidence in our trades, and acquaints us with various market scenarios. I hope you will understand the importance of looking at multiple time frames from the details to the big picture. If you find the video helpful, please like it and subscribe to the channel. You can also watch other videos and learn for free on my YouTube channel.